Hello trader, welcome to my channel. My name is AdeDavidson. I'm a trader, and right here on this channel, I share my knowledge, experiences, and document my journey into the forex market. If today is the first time of visiting my channel, do well to give this video a thumbs up, subscribe to the channel, and don't forget to tap the notification bell so that you get notified every time I upload a video like this. Without much talk, without further ado, let's get right into it. Alright, welcome. In this lesson, we will learn about some terms that traders use in forex trading. Okay, so you want to get familiar with these terms, you want to know them, you want to understand them, so that when you hear it or when you see it, you won't be surprised or it won't feel somehow strange to you. Okay, it won't be new to you. So you want to be familiar with these terms as a trader. So, introduction to some forex trading terms. The first one we have on our list is pip and pipette. Pip, which is a percentage in points. In forex trading, a pip is the standard unit for measuring price changes, representing 0.001 for most currency pairs, while there is an exception for JPY pairs, which is represented as 0.01. A pipette, on the other hand, is a smaller fractional measure of price movement, which is equivalent to 1/10 of a pip, representing 0.00001 for most currency pair and 0.001 for JPY pairs. So what this simply tells you is a pip is what you use to measure price changes or price movement. So when price moves from one price level to another, okay, what you use to measure this movement or that difference in price is pip. Okay, is the pip. Okay, so why pipette is a smaller kind of pip. Okay, for a pip to form, a pipette has to move 10 times, or let me say a pip is 10 times bigger or greater than a pipette. Okay, a pipette is a smaller part of a pip. Okay, on the chart now, if you look at the prices of any currency pair to your left hand side, so you see that among the numbers, like among the price tags, like the numbers that is attached to the price tag, okay, the last number there is moving so fast. The last number there is the pipette. It moves so fast, like very fast. It's faster compared to the pip. Okay, so a pipette is 10 times smaller compared to a pip. All right, in a more simpler term, both pip and pipette is simply defined as the movement of price from one price level to another, while one pipette is faster than the other, which is pip. So that is basically what I just explained now. So a pip is the difference between one price level to another, or when price move from one price level to another. So what you use to measure that difference or that price movement is the pip. Okay, is the pip. All right. Also, a pip is usually the fourth number after the decimal point of most currency pair, while a pipette is the last number after the decimal point of a currency pair, with an exception for JPY pair, which is pip is the second number after the decimal point, while pipette is the last number after the decimal point. So for example now, Euro USD. Let's say the current price of Euro USD is 1.36592. Alright. So in this example now, the pip here is 9, which is the fourth number after the decimal point, while the pipette is 2, which is the fifth or the last number after the decimal point. Okay, hope you understand it much better this way now. While for JPY pair, let's use the NZD JPY for an example. Okay, 87. Let's say the current price of NZD JPY is 87.125. All right. So here, the pip is 2, which is the second number after the decimal point, while the pipet is 5, which is the last number or third number after the decimal point. Hope you have a better understanding about that now. So a pip is the last number, a pipet rather, is the last number after the decimal point, and it's more faster than the pip. Okay, why a pip is the fourth number after the the first number for currency pair, or second number after the decimal point for JPY pairs. Okay, that is what is called a pip. All right. The next terms you want to check is the base and quote currency. So one thing you have to understand is most currency pair in the forex market, their names are denoted like the names you see for most currency pair are more like a code, an ISO code, which is a international organization for standardization or something like that. Okay, so I think that, yeah, something like that. So this organization are the one in charge of giving every currency pair the codes, which is the name that we call them today, the likes of Euro USD, AUD USD, GBP USD, and a whole lot of them. So they are all in codes. Okay, so basically base currency are the first 3 letters of a currency pair, while the quote currency are the last 3 letters of a currency pair. So for example, now we have Euro USD. So the base currency here in this pair is Euro, while the quote currency here in this pair is USD. Hope you get that point now. Okay, the currency pair codes are always expressed in units of the counter currency to get 1 unit of the base currency, e.g. USD card, which is 1.37655. What this means is you need 1.37655 of Canadian dollar to get 1 United States dollar. Okay, this means USD is much bigger than Canadian dollar. Okay, so which is 1 USD, 1 United States dollar equals 1.37 Canadian dollar. All right, so that is basically what base and quote currency means. So all you just have to know is for every currency pair that you see, the base currency, okay, the base currency is the first 3 letters of that currency pair, while the quote currency is the last 3 letters of that currency pair. Let's use another example now. For the likes of NZD-JPY, yeah, NZD-JPY. So NZD is the base currency, while JPY is the quote currency. Okay, let's use another example for AUD-USD. AUD is the base currency, while USD is the quote currency, and so on and so forth. Okay, that's all about base and quote currency. Okay, note, all right, you have to note this: the euro is usually the base currency against all other currencies. Okay, you can't use euro as a quote. Same thing is applicable to GBP, but there's an exception in euro GBP. Here GBP is the quote currency. Okay, so what this simply says is against all other pairs, okay, against all other pairs, the euro is always the base currency. Against every pair in the forex market, the euro is always the base currency. Same thing is also applicable to the GBP. Also, every currency pair that is paired with GBP, yeah, that is paired with GBP, the GBP is always and usually the base currency. Okay, exception, like there is an exception in the case of euro GBP, where GBP is the quote currency, while euro remains the base currency. Okay, so that is one thing you need to keep in mind as a trader. So another term is a broker. A broker is more like a middleman or intermediary between you and other traders in the forex market. They help you to pair your order with other traders order in the forex market. Also, a trader gives you leverage, which increases your trading capacity in the forex market. Okay, a trader is more like a middleman. Okay, it's more like someone that is in between you and other traders that participate in the forex market. Okay, so whenever you buy a particular asset or particular currency pair, okay, there has to be another trader who is willing to sell to you. Okay, for a trade to take place, there has to be a buyer and a seller. So you get now. So a broker is the one between you and that other trader. So if you want to buy a particular asset, let's say Euro USD now, there has to be another trader that is willing to sell to you, all right, before you can say, okay, you take a trade. Hope you get the point now. So a broker is the person, is the person that is in between you and the other traders in the forex market. Okay, it helps you to buy, to pair your buy and sell order with other traders orders in the forex market. So that is one thing you need to understand. So another thing the broker do is they also give you leverage. Like they give you leverage. Leverage is simply a more like a borrowed fund. Okay, one thing you need to understand is your $1, your $10, your $500, they have no say in the forex market. So but thanks to the leverage that the brokers give to you, so you can simply trade with all these small amount of money in the forex market. You can trade in the forex market with all this smaller amount of money. Okay, thanks to the leverage that your broker gives to you. So what a broker did is they give you leverage as a trader. So that is one thing you need to understand about broker. All right, another term is a spread. So a spread is simply the difference between the bid and ask price. For instance, the difference between Euro USD price, which is 1.35261 and 1.35302, is 4 pips. It's a form of commission that your broker charge you every time you open a position on your trading account. Okay, as you proceed in your trading journey, you learn to understand this better. Okay, you learn to understand this better. You learn to understand what a spread is. Okay, a spread is simply the difference between the bid and ask price. Okay, the bid and ask price. All right, so let's say you bought Euro USD at a particular price level now. Okay, your broker will sell to you. Your broker will sell or will pay your buy order with another trader sales order at another particular price. So the difference between these two price level is what is called spread. Okay, this is something that your broker charge you for. Okay, they charge you for this. They charge you spread for every position you open or for every trade you place in the forex market. So with time, you get to understand all of these concepts or all of these terms much and more better. So the next terms you want to look at is commission. A commission is simply a fee your broker charge you after every closed position on your trading account. So for instance, now let's say you take a trade which at the end of the day was profitable. Okay, so let's say maybe you make $1,000, $1,000. So when you check your history, okay, when you check your history, you understand or realize that your broker take some certain amount out of it. Let's assume maybe $10. So what you will have left as a profit for the day is now $990. Now $990. So that little that $10 that your broker charge you is more like some is a commission that your broker charge you or that your broker take from that particular trade. And one thing you need to understand is they take commission for every profitable and for every losing trade. Okay, so broker charge you commission for every trade you take in the forex market. Leverage, I've talked about this before. Okay, this is simply a borrowed fund. It is the 99% out of 100% of the money you use to trade. This is given to you by your broker in order to increase your trading capacity in the forex market. Examples of leverage include 1:50, 1:100, 1:500, 1:2000, and etc. etc. What this means is for every $1 you fund in your trading account, it is viewed as $50 in the forex market. Yeah, so just like I said the other time, leverage is simply a borrowed fund. Okay, let's say you want to buy Euro USD, want to buy 100,000 units of Euro USD, which is one standard lot. So and you have a 10 pip stop loss. So for every pip movement now you risk $10, which is overall you're losing $100 at the end of that particular trade. So your trader, when you fund your trading account with this $100, if you take it to the market directly, like you don't have anything, you can't take it to the market directly to trade with it. So what your broker gives you is leverage. So basically, your $100 that you are risking on that particular trade is seen as $50,000 if you are using 1:500. Okay, it is seen as $50,000 in the forex market. So that is the kind of leverage like that your broker gives to you, or that is what leverage simply means. Okay, it increases your buying capacity in the forex market. Okay, so another terms you need to get familiar with is margin. The margin is simply a portion of your funds that your broker set aside from your account balance to keep your trade open and to ensure that you can cover the potential loss of the trade. It's a form of collateral or safety net that your broker needs to keep your open position or to take a new trade. Okay, a margin is simply what your broker needs, like something, the amount of money that you need to drop whenever you want to place a trade. Okay, this is required of you for every position you want to open in the forex market. Okay, so basically a margin is what your broker simply use to keep your trades running. Okay, it's what they use to allow, okay, it is what they use to allow you to open more positions, to open more trades. Okay, and also you want to keep in mind that your margin level must not be below 50%. Always make sure that your margin level is not below 50%, because whenever your margin goes up, is exhausted, that is when you get something called the margin call. That means every money, everything you have in your margin has been exhausted. Okay, when that happens, all of your running positions will be closed out even without hitting your stops. Okay, so you want to make sure that your margin level is always below 50% at every point in time whenever you want to place a trade. Okay, so another terms you need to understand is as a trader is equity. Okay, this is the amount of money you have left in your trading account to open a position. Note, this fluctuates if you have an active or open position. Okay, I think this have explained itself. So lot size. The forex market is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. When you place orders on your MetaTrader 4 or 5, orders are placed in sizes quoted in lots. Okay, and there are 4 types of lot sizes, which are standard lots, micro lots, and nano lots. Not all brokers have these nano lot sizes or make use of these nano lot sizes. Most brokers don't make use of it. Standard lot is 1, while mini lot is 0.1 or 0.10, while micro lot is 0.01 and nano lot is 0.001. But most brokers don't allow this lot size. But likes of I think Deriv, Deriv, you can do away with it. Like you have access to this type of lot size on Deriv. I think volatility 151x or something like that. Yeah. So lot size simply how you measure your risk. Okay, this is what you use to place trade on your broker account. Okay, this is what you use to place trade on your broker account. That is basically what lot size simply means. All right. So another terms you need to get familiar with is take profit. This is simply a price level where you want your broker to close your open trade or position in profit when price moves according to your prediction. It is a method traders use to secure profit in the forex market. It is usually higher or lower than your stop loss price level depending on the trend. Okay, so what is take profit is simply a certain price level on the chart. Okay, so let's say maybe you anticipate a particular price to buy from one price level to another, so but you are not constantly online to monitor that trade, so you use take profit. You use take profit as a way telling your broker that whenever price trades up to this price level, stop me, like close me out in profit. Okay, close me out in profit. Either I'm online or I'm not online, just close me out in profit. Hope you get the point now. So that is basically what take profit is. All right, another terms you need to get familiar with is a stop loss. Stop loss is simply a price level where you want your broker to close your open trade or position in loss when price moves against your prediction. It is a method traders use to safekeep their trading account from wounds or severe loss. So a stop loss is a risk management method that you need to understand or know as a trader. This helps you to mitigate potential losses in the forex market. Okay, so you will not always be online to monitor your trades, so you want to make sure you use stop losses in order to reduce the amount of money you lose out of your funded account. Okay, so anytime price go against your predictions, so that it soon wipe out all your accounts within one trade. Okay, you won't lose all your accounts to one trade, so you want to make sure that you make use of stop loss at every point in time, or every time you place a trade. Okay, it's simply, and stop loss is simply a price level where you tell your broker that when price sell, let's say you take a buy, so you are simply telling your broker that when price sell to this price level, okay, simply stop me out in losses. Okay, stop me out in losses, stop me out of these losses in this certain amount of money. All right, so that is basically what stop loss is simply all about. So another terms you need to get familiar with is entry. Okay, an entry is simply a price level you mark as point of interest to buy or sell a currency pair when price trades into it. Okay, an entry is simply a price level on the chart, or a price level where you tell your broker to buy or sell you in, to activate your buy or sell order whenever price trades to that price level. Okay, that is simply what an entry is all about. Okay, order types. There are different types of orders that trader use to execute their order in the forex market. Order type is simply the different method you can use to execute your trades. There are 4 types of order, which include instant or market execution, limit order, stop order, and stop limit order. So over time, and as we proceed in this lesson, you will learn more about these types of order and how you can make use of each and every one of them. Okay, as you proceed in your trading journey, you will learn more about it. So the last but not the least of this segment is the trend and consolidation. So this is another terms you need to get familiar with. Okay, a trend and consolidation. So what exactly does a trend mean? A trend simply means price moving in one direction, moving in a specific direction. Either price is going up or is going down. Either price is going bearish or is going bullish. Okay, that is what a trend is simply all about. That is price moving in a particular direction. Okay, why consolidation simply means price moving around. Okay, moving around between 2 price level. It is chopping around, it is consolidating or ranging between, let me use the word ranging. Okay, price is ranging, you see price ranging between 2 price level. Okay, between 2 price level. That is basically what consolidation means. Why a trend is when price is moving in a specific direction. All right, so that is basically all I want to share with you right there in this video. You can make more research about each and every of these things in order to have more knowledge about them, but I believe everything I've shared with you right there in this lesson is well enough for you as long as you understand it. Okay, and that is all I want to share with you right there in this video. But before you leave, do well to give this video a thumbs up, subscribe to the channel, and don't forget to tap the notification bell so that you get notified every time I drop a video like this. Until next time, I wish you good luck, good day, and good trading.